The real estate market in Canada isn't just cooling, it is falling off a cliff. We're officially seeing the second worst start to a year since 2008. And some forecasts suggest we likely haven't hit bottom yet. So, Sam, it's good to have you back on the Personal CFO podcast.
Yeah, it's good to be back. Excited.
Before we dive into analyzing the state of the real estate market, I want us to answer the following questions for the listeners. So first is, why is it important to talk about the real estate market right now?
Yeah, I mean, the real estate market is Canada's one of Canada's largest economic sectors, right? So I think the conversation has also been dominated over the headlines over the last 10 years because of how real estate's appreciated. And then all of a sudden now it's in the news again because we're seeing a huge decline in housing starts. We're seeing a huge decline in property values, especially condos. And people have to make decisions like their mortgages are renewing. They're considering, some people are considering upsizing. Some people are trying to get into the market for the first time. So thinking, is this the right time now that prices are falling? But also thinking hey, the starter home kind of mindset is a little bit dead right now in most places in Canada because you're not really getting a starter home unless you're paying, $800,000-$900,000. So it's a bigger investment than it ever was before. And I think it's relevant to talk about it now, just given the current situation that we're in. So it's, and I think looking at the housing starts numbers, we're seeing the second weakest housing starts in 2008, 2009, which is remarkable, right? Canada didn't see as much of a crash in the financial crisis as the US did in terms of the housing side, but it's still, we saw a crash. And I think it's the third worst start to a year, if my numbers are correct, since the 1970s. So it's not good, right? We're not in a good position from a housing perspective, at least for people who own their current properties. And there's some people like the younger people who are kind of excited.
Yeah.
Hey, if housing prices are coming down, maybe this is my opportunity to get into the market. So it's important timing to talk about this now.
Yeah. And I'm excited to dive into the stats and the forecast as well in order to help people navigate this current environment. But who would you say this conversation is for? So people are tuning into this podcast. We want to be really diligent with their time and respectful with their time. So who is this suited for, this conversation today?
Yeah, I think anyone who's a current homeowner, anyone who's wanting to get into the real estate market, if you're a real estate investor, if you're a renter, right? So pretty much anyone on that spectrum, it pretty much captures a lot of the audience. And if you're just generally interested in the state of housing in Canada, I think this is a fantastic, hopefully a very insightful piece as we're going to get into some of the numbers on this and get into some hypothetical scenarios and try to make it directly applicable to you versus just talking macroeconomic data.
Yeah, that's a good point. So how are we going to be able to help people listening today? How are we going to be able to make a difference with them?
I don't know about you, but when I have conversations with clients about housing, it often turns into more of an emotional guided conversation than just look at the numbers and see what the best outcome is. And so today we want to be objective about the housing market. There's this, phenomena where people will overvalue the home that they're selling and undervalue the home that they're buying, right? Because of just their attachment to the property. So we want to take that out of the equation a little bit and look at the statistics and really answer the questions of is this a good time to buy? Is this a good time to upsize your home? Is this a good time to buy an investment property, right? As classic financial planners, we're not necessarily going to give you an exact yes or no answer, but we will help you think about some of the parameters around these decisions and what should be influencing these decisions over and above just the emotional side of owning real estate.
Yeah, that's a good point. I would take a spin into what you said as far as is it a good time? I would say more, what is a good decision based on your specific situation? I would say more so that than trying to pinpoint, because I just talking subjectively from, conversations and experience, I do have friends who bought homes and they're like, Guy, I couldn't care less if prices continue to go down or up. I just really wanted that home. I'm really happy about it. And that's just what I wanted. I could not care less where prices are going. I'm going to be there for the next 10, 15, 20 years, right? So I think this conversation is for people, like you just said, maybe helping them remove the emotions, but helping them essentially bridge the emotional side and the quantitative side of making the largest financial decisions that you'll ever make in your life. And you alluded to that in terms of back in the day, we grew up in, you start with a starter home, maybe a condo, then you go to a townhome, then you go to your bigger home. That's a baby boomer kind of strategy, right? get in as soon as possible. I kid you not how many times I've heard that either from realtors that you got to get in because prices will only keep rising. Well, they've been down for the last 3 years of, depending on which start you and ending you're using at between 22 and 28%, right? So clearly that statement, like we're trying to demystify those fears that I feel is being portrayed around the real estate market. And hopefully that's going to help you make a more objective decisions while also, still being using your emotion as far as buying something that you really like
Yeah.
and you really enjoy and makes you happy because that's really what matters. So let's dive in.
That's a great point. Yeah, I'm excited to dive in. Let's do it.
So do you want to talk about the current like house pricing correction we're seeing first like nationally, but also maybe breaking it down at a high level, province to province?
Yeah. So because Canada is so spread out in terms of our density, right? Like we've got super dense places in obviously Vancouver, we got Toronto, we've got Quebec, Montreal, kind of those areas, but then everywhere else it's like dense and then nothing, right? And so it is very regionally driven, the housing price correction. So when we talk about like the Canada national average, we have to keep in mind that this is excluding a few specific places in the prairies and in Quebec that have actually done really well over like from just a pricing return comparison analysis. So yeah, so I guess one of the things that jumped out at me was that on the Canada home price index, I think the monthly index has been negative now for 14 consecutive months. So it's not just like, hey, we've got 1 month where it really dropped, 1 month where it crept up a little bit, 1 month where it dropped. No, it's been negative for 14 consecutive months. And that's important to understand. And then how that breaks down regionally, basically in January of 2026, Ontario and BC led the declines. So the GTA average was about 6.5% lower in terms of home prices than a year before. And British Columbia average home price was down about 1.9% year over year. And Alberta saw some drops. Calgary was down roughly 3%. Quebec, though, and then Newfoundland had 7% gains. Okay, so Quebec City had 7% gains and Newfoundland had 9.7% gains. And then the prairies and the rest of the Atlantic regions were pretty much even slightly positive over that time frame. So I've got a lot of friends and family back in Saskatchewan. When I'm on conversations with them and I'm saying, "Hey, real estate's dropping," they're like, "No, it's not." "Oh yeah, for you, it's not." But for the rest of the country, it is. And I think that just speaks to how fractured we are in terms of just where our density lies. And it's quite eye opening. But where we're most densely populated, we're seeing significant price decreases over the past 3 years.
Yeah. Yeah. So aggregate, it was down 2.7%. So over the year of 2025 nationally, but like what you just alluded to, it's very fragmented. And the Quebec, I'm not surprised by this data at all, just given how fraudy the Ontario and the BC markets were, namely Toronto, also the GTA, but also the Vancouver area. I think those were extremely frothy markets. I'm not surprised at all to see this data. And Quebec, I think the prices are one of the reasons maybe it's still rising is because I think this market in general has been just catching up. I don't think we've seen the type of price increases that we've seen in other provinces. And just to give you anecdotally, I'm from a small town, Saint-Hyacinthe, Quebec, and it's about 45 minutes from Montreal. And with my dad, we always have funny conversations because when housing is like the topic that everyone I feel talks about, and he's like, "Guillaume, this is crazy. You have like detached homes now in Saint-Hyacinthe for like $500,000." I was like, "Dad, you have like a 1 bedroom shoebox for like $490. It's starting prices here in in Victoria, Vancouver, and Toronto." So it just shows you kind of those regional markets where now people are kind of seeing price appreciations, but they're definitely not used to that because 20 years ago you could build a brand new home for just about $200,000, like detached. 2,000 square foot home type of things. It just shows you, So some provinces are still rising because I felt they started from a much lower floor, right?
So
Which kind of makes sense.
do you think it's fair to say that all of the warnings in the past maybe 5 to 7 years that, Vancouver and Toronto were like at risk of being in a real estate bubble? Do you think it's fair to say that now looking back, that was true, that it was a bubble that's bursting, or do you think it's too early to tell?
No, I think it's rightfully so, and we're gonna get into like the drivers of the corrections, namely just the cooling off with immigrations, and then the just hot capital. I think that's what people used to scoop up. I think many condos, and it was a no-brainer. And yes, people have made a lot of money. And I actually have another like anecdote to that, in terms of, I think that we saw that time where you needed to get in, you put it almost nothing down, and then you're able to kind of flip it. And then we went through that phase. I did have one specific client situation that I want to bring up, which I think is funny. He said, Guillaume, I'm a real estate guy. Like, I don't like the stock market. I don't like investing. I've never made money investing in stocks and bonds. And that experience for that specific person really shaped the way they're going about building wealth. Turns out also, like, they really like, in the real estate market, they really like investment properties, and they want to build a real estate investment portfolio. The point is, I think in that period, I think you saw a lot of people making a lot of money quickly. And I think
Mm-hmm.
that just accelerated their love for real estate. And of course, with how ingrained real estate is with in our culture, I think that those were just, and then you had immigrations, and then you had those shortages, and then of course the pandemic just accelerated everything, and then we saw the peak in 2022. So I think all the factors were brewing for a storm, and then once everything started clamping down, and then you have maybe exodus of capital, and then people are seeing no, and then you have a rising supply, and then now you have like a lot of condos just sitting, and then a
Yeah.
ton of projects being canceled, which we're seeing left and right. So I know, when are we going to see the pendulum coming back again? Again, I mean, who knows? We're not here to make those kind of forecasts, but yeah, those I think those factors were just brewing for a storm, and that's what we're seeing now, and that's why we're seeing prices being down,
Yeah.
over 20 something percent from peak to trough from March 2022 to now. While me stock market, again, as a barometer, just because a lot of our clients are basically debating, do I invest in the real estate market? Do I invest in the stock market? What are the trade-offs? I mean, markets are up between 70 and 80%. So it's the S&P 500, sorry, the S&P TSX Composite Index is up 70% over that same 3-year period. The
Mm-hmm.
S&P 500 Index is up 80%. And then just a globally diversified portfolio of equities is up 64% over that same period.
Yeah. And I think, this gets into a conversation of like hindsight's always 2020.
Oh, yeah.
But when you want to put decision filters on when you're making a decision like buying real estate, if you're looking at the past like 10 years as your projection, when I say past 10 years, people in 2021 and 2022 were looking at returns from 2015 as their barometer for expected future returns on real estate, and seeing that, man, you throw leverage in there and then the returns get amplified. So this is a no brainer. Meanwhile, ignoring like the 30-year picture of what real estate in Canada has actually done, ignoring the factors that were contributing to the real estate price increases over that point in time, that they weren't sustainable. And so when you put decision filters on of like, should I buy? It's hard to time things, right? So we're not advocating for market timing. But if you were to look at things and over a 30-year history, and instead of taking the 7-year history, which was the craze and the crazy like 20% home price increases, then you would have probably plugged in a 4 to 6% expected return for real estate instead of that 10 to 15% that people were anticipating on an annual basis. And that would have drastically, hopefully, changed your perspective on whether or not it was actually the right decision to get in, and made that comparison between, should I just have my money work passively for me, or should I put it to work in real estate, have the hands on, have the liquidity risk, all of that stuff baked in, right? So I think we need to be putting on these decision filters when we're making big financial decisions like investing in real estate. It can't just be like an emotional attachment to it and a recency bias of like the past 5 to 7 years of returns. And I think we're seeing that now, because when we look at RBC's data, what we're seeing is we're shifting more into a buyer's market. We've been in a strong seller's market, and now we're shifting more into a buyer's market. There is more supply on the market than there is demand.
I think it makes sense. But I think before we dive into this,
Yeah.
let's just rewind. Sam will share his newest build tool about investing in a real estate investment property versus the equity market at the end of this episode. So make sure you stay tuned until the end for this, as I'm going to share my screen. Of course, if you're on the podcast, you're going to only be able to listen to this conversation. But if you're on YouTube, you'll be able to see it visually. But let's just go back to the correction, I think, that we're seeing there, and then we'll get into the state of the market. But do you want to just walk us through kind of where is this correction sitting versus the other corrections that we've seen, I think we've seen in history?
Yeah.
Just to,
So The last time Canada saw a sustained drop was the 2008-2009 financial crisis, like we alluded to earlier. So resale prices fell about 8 to 9% nationally from peak to trough. To put that into perspective, we're looking at 22% this time around. And in 2008 to 2009, it was 8 to 9%. Okay. We're seeing a much bigger price drop now than we did in the 2008 financial crisis. And then prior to that, in the 1990s, Toronto area prices plunged about 38%. This is inflation adjusted between 1988 and the mid 1990s. So, yes, the 2008 drop was the previous benchmark for a correction, but today's decline is much larger and much more comparative to the drop in the 1990s than it is to the drop in 2008, 2009. And this is, I think, the first time that millennials are seeing this, which is interesting, isn't it? Because maybe the oldest millennials were maybe buying houses in 2008, 2009, but the majority of us, we were still in high school, right? And so, or maybe in university. And so when we're looking at that, this is really the first time that millennials have seen a price drop in our lives when we've actually been in the real estate market. And so this is crucial for knowing how to react to this. We know that a lot of our clients are millennials. We know that a lot of our listeners are millennials. So how do we react to this as millennial investors is an important thing that we're going to talk about too.
I think this is really healthy because, again, just talking with, referring to the conversations I've had, there's a people who absolutely love real estate. And especially the older cohort, the baby boomers, Guillaume, real estate never goes down. Because if, in their experience, I mean, bond yields peaked in the early 1980s. And then we went through like a 42-year period, really, where fixed like interest rates just went down and hit like rock bottom in during the pandemic. That was a 40-year decline that was supporting kind of price appreciation as well, right? Lower rates, higher prices. That's one thing. And then the other thing to which you just alluded to, the last real crisis was 1990, 2008. Even if prices were down 8 to 10%, I mean, the markets was just like completely shitting the bed, was down 50%. So relatively speaking, like the decline in house prices was very mild compared to everything that was happening, around them with their other side of their portfolios. So maybe people didn't feel it as much, right? Today we have like one of the biggest contrasts, which is the kind of complete opposite, where real estate are somewhat collapsing versus, other side of the portfolios are rising substantially.
Mm-hmm.
But I think it's really healthy for people to realize that no, real estate just doesn't go up and down. Oh, it's not an escalator. That's what the other thing I heard Guillaume, just get into real estate. It just go up and then it's flat. It goes up, it's flat, it goes up. It's like this a permanent life insurance policy, right? With the cash value that just keeps rising forever. Yeah. And the reality is, no, there are risks involved. And I think that's it's a healthy thing. That's a healthy thing to do, especially when you see prices coming back to or being normalized in fraudy markets. I think it's just extremely healthy. So
yeah, and I just think that as well when we're talking about people with that mindset that real estate's only ever going up and it's the best thing ever. I think their view would change if real estate was priced the same way that the stock market was. Like imagine if they got a daily inbox report showing the appraised value of your property today versus yesterday, right? And it could actually give an accurate price, based on resale values and based on other things. But if it could actually give that price and we saw that on a daily basis, I think we would see similar emotions surrounding what people view in the stock market as in the real estate market. And I just think that because of that, lack of reporting, return smoothing mechanism at play, we're not seeing that because all people think about is I went to sleep one night, I woke up the next day and my real estate was still here. I could still feel it. I could still touch it. It's still the same value. And then when they bought it and when they sold it, all they see is a straight line up from the buy price to the purchase or to the sale price. Therefore, it only ever goes up, right? And I just don't think that that's a realistic, mindset or a rational mindset to have.
I can tell you that their mindset is changing about real estate and especially builders. So I've talked to a few builders here in town and some are my clients actually. But of course they're pro real estate. There's no doubt about it. But there's a few caveats with real estate that people are realizing, especially as they're older. And I've talked about this on the podcast, but I'm seeing it happening in real life. Is now some people are basically waiting to sell their home in order to downsize. And this is probably like worst time, especially if you're on the higher priced market where like
Yeah.
now there's even less buyer, it's even more difficult to get in. Now there's people are realizing like, holy, my wealth is tied into this. I need to sell, downsize, and then to bring liquidity in order to fund to retire essentially because they
Yeah.
can't just retire tomorrow. And I think there's more and more people who are realizing that the impact of this scenario. I think maybe the millennials or the Gen X maybe have already realized that diversifying was a good thing. But people who I think were maybe solely focused on real estate, now they're realizing, wow, okay, the need for diversification. And also they're realizing it by looking at how the stock portfolio is performing because they're like, oh my God, what if I had twice the amount that I had in the stock market over that period instead of being tied to my home. Again, that's very time specific. We don't know. We can't really time the market, right? I'm sure at some point maybe we're going to see the opposite, where maybe
Hmm.
real estate prices will continue to rise and the stock market will be in a deep correction. That's very possible as well. So
Yeah.
again, this is very time specific, but the point is it is happening and people are really, I think they're realizing it that, yeah, there's a cost. And then we're going to allude to that into your calculator at the end. There's costs that sometimes are not always factored in.
And I think so I think it's fair to say, summarizing this point here, that what we've seen over the last 3 years is a once in a generation housing correction. We haven't seen this since the 90s. Housing starts, we haven't seen it this low since 2008, 2009. This is a once in a generation housing correction. And it's important, the next piece on basically what the key drivers are to this, because that, while we're not trying to give indicators of when you should get in versus when you should upsize versus when you should buy, all of that stuff, from an educational piece, it is important to know why this is happening and then maybe what, if anything, to do about it.
Yeah. Do you want to talk about the biggest driver?
Well, yeah. So the key drivers of the correction. So there's a few things, right? And we saw a lot of this being used to build up home prices. And now we're seeing the opposite of it being used to drive down home prices. So one of the biggest drivers is definitely mortgage rates, right? So after years of near zero lending rates, the Bank of Canada's tightening ended with 5-year fixed mortgages around 4.3 to 4.5%. And that's up 2% from 2021. And I remember when I bought my home in 2020, locked in a 5-year fixed rate at 2.49%. And I was kicking myself a little bit because I knew I made the right decision by going with fixed. I knew that in my head because I didn't want the ups and downs of variable rates. And I thought, we're probably never going to get lower from here. But all my friends that I was talking to were at like 1.3% variable rate. That is effectively free money, right? That's effectively free money. You don't need to put any extra principal down on that, right? Because you could get that almost that equivalent in a low to no risk GIC if you were to just put your money somewhere else. So you really didn't need to pay that down. It was effectively free cash that they were lending you. And now we're seeing up 4.3 to 4.5%. So about 2% up from 2021. So that's wild. Yeah. I don't know. Like we're seeing some of those mortgages, most of those mortgages coming due from 2025 and in 2026 as well. Not sure if we're talking about this later, but 60% of mortgages are renewed either in 2025 or are renewing in 2026. So that's going to be a bit of a sticker shock for the new price. So now basically what's happening is higher rates are affecting affordability, right? So I guess I kind of alluded to this earlier on like the supply and demand. If there's more supply and there's fewer qualified buyers, then that's going to affect things. That's going to drive pricing down.
Even more, yeah.
Yeah. So those are the few things kind of on the mortgage rates, and then RBC's
And
basically. Yeah, sorry.
yeah, so one comment about
Yeah.
the changes in rates. We as financial planners, we're not a mortgage expert. We do have mortgage partners if you need help around financing and making the best decisions down there. But what we can do as well is include that into your plan, model different scenarios, and help you make the best decisions around your kind of, I would say, financing options within your overall goals and plans to make sure that everything is kind of working out, especially if now your cost is like substantially higher, especially if you're on a variable basis. Again, we don't know where rates are going to go from now on. They might continue to like trickle down and whatnot. But anyway, if you do have worries around that, that's one thing that we can help you with.
Yeah.
Please continue.
Well, so some of the other things, according to RBC Economics, buyers' recovery stalled in the face of persistent affordability challenge and economic uncertainty as well. Household budgets have less room to add housing debt. And over the past year, Canadians went through 10 Bank of Canada rate hikes. Um, and
But that was like 2022, 2023.
20,
Yeah.
23, Canadians went through 10 Bank of Canada rate hikes, and ultimately borrowing costs remain still very high based on like kind of more recent historical norms. So if we're looking at comparing what drove the price appreciation, low interest rates, high immigration, low barriers of entry into the buying a home, and now we've got higher stress tests to meet. We've got higher costs of borrowing. We've got lower immigration, and relative to the 2010s, borrowing costs are high. And so those are some of the things on interest rates. But I'm curious what you're seeing from more of an economic, like supply and demand side, that's kind of also pushing this to be.
Yeah, well, on the demand side, in terms of factors, so there's a couple of things, right? So in terms of like job income growth, and I don't want to turn this podcast into kind of like macro like forecasts here. I haven't looked actually to be really honest in terms of the unemployment rates and whatnot. I would probably have to like
I think
confirm
it's like
this.
over 6% right
Over
now.
6%?
Yeah,
Okay.
it's over
So I would have to
6%.
like brush up my knowledge there. But of course, if you look at like the first time home buyers as well, depending on the quality of employment that they're getting, that's going to affect the demand. So yeah, and then there's of course, that's on the demand side. So assuming that the job market is kind of holding up, that's going to be a positive, hopefully, that will help provide a floor for the real estate market. But again, I think that's mostly for entry level home prices or condos. And then in terms of the mortgage renewal, you mentioned it. So there's going to be about 1.15 million mortgages that will come up in renewal in 2026. So that's going to be interesting. The supply side, I think we've already mentioned that in terms of the inventory is rising. Well, I mean, you just go back to the pandemic, the bidding wars.
Hmm.
People were like,
Yeah.
again, I didn't go through that, but just reading articles, it sounded to be extremely stressful and frustrating, I think, for a lot of people who were trying to get the homes that they wanted and they were just being like outbidded all the time. To me, it sounds like a horrible way to make one of the largest financial decisions in your life. But now, given that it has been shifted to a buyer's market, I mean, I think those days are long gone. If we look at I'm not sure if you have the chart here, but if you look at the months of inventory, I think we're back to 5 months right now. So if there's like kind of new, like how long it would take to actually clear out the market, and then if you go to like sales in terms of new listings, I mean, it's been like declining, and then now we're back to just below 50%. Was it 45% and change?
Hmm.
So again, just confirming that we're like truly in a buyer's market. I always laugh when I see charts about like seller's market or buyer's market. And I mean, when I was following the price declines and the inventory rising and, the clamping down on immigrations and the restrictions, especially around like student permits and whatnot, they're trying to really limit that. I was like, well, I mean, of course we're going to be in the buyer's market at some point.
Yeah.
Like we have to, because I feel from a realtor perspective, I feel we've always been in a seller's market, for
Yeah.
forever, and it is true. But I feel the data now, it's unavoidable. Like in terms of the state that we're in, and like the data, I think it's pretty obvious now that things have shifted.
Absolutely.
Is it a good time for new buyers to get into the market?
Well, I guess you could say it's better now than it was last year. So basically, prices are down, right? We've got more options, especially now in more of our densely populated cities, even places like Calgary, right, where it was prior, like lots of people were moving there because of their lower housing prices. It was still climbing at a substantial rate, and now Calgary's even going down, right? So Vancouver, Toronto, Calgary, some of those major hubs, they're at a more reasonable price than they were a few years ago. So if you were priced out of the market a few years ago, you might be back in now. So that's something to, take some solace in and take some hope in. Maybe this is a better time, and just from purely an affordability standpoint. And mortgage rates have potentially peaked, right? There still could be. We just don't know. I think it's not wise to speculate on mortgage rates, given that it seems like our economy is really in the hands or out of our control in some context, right? With the tariff situation down south, who knows what the impacts of that look like a year from now? Who knows if one stroke of the pen can raise our unemployment by 2%, right? And how that would impact things. So I don't think it's wise to speculate on like rates can't go up or rates are definitely going to go down. I always love to hear this because in talking to clients, we always hear what they're saying from their banks and their brokers and all of those things. And it's like, yeah, mortgage rates are definitely going down. They're definitely going down. I just like, I don't think I just don't think that's a guarantee. It is probably more likely than not, but it is likely that they've peaked. But again, you just can't, I don't think that should be a basis for your decision. So basically, there's a few ifs, right? Like if you have stable income, if you have good savings, if you still have an emergency fund baked into the side, right? Like that you don't need to spend to get into this property. And if you don't care about staying in this property for 20 plus years, right? If that's your goal, you're staying in this property for 20 plus years, it is probably a better time to buy now than it was 3 years ago. I would say definitely, it's a better time to buy now if you were just looking for best bang for your buck. Now, that doesn't mean prices can't continue to go down. That doesn't mean we're not just seeing the start to something like this, right? Where maybe we look at pricing going down who knows, another 10% over the next year. We don't really know what that's going to look like. It's going to be really interesting seeing this buyer season in 2026, like to see like what actually happens when mass markets actually start buying houses. That's going to be interesting. It is still a challenging environment, though. We still are seeing the lingering effects of higher inflation over the 20s. So our dollar doesn't necessarily get us as much these days. So even though pricing has dropped relative to what it was 3 years ago, relative to what like the price to income ratio was back in like the 2000s, we're still at a much higher place than we were back then, right? So based on the average income to housing price, right? Like that's still out of whack. There's still stress tests on mortgages. You still may be priced out. Who knows, right? But at the end of the day, prices are lower. The economy seems to have stabilized a bit more. Interest rates seem to have stabilized on a more affordable basis, right? We're seeing some now 3-year renewals getting priced at 3.8, 3.9% on fixed rate. So that's, a pretty decent lending rate right now. So yeah, I think there's some reason to be optimistic about this being a good time to buy.
Right. I'll add to this a few things. If you want to get into the market, this is how I would approach it. If you ask me if it's a good time to buy, first I would put my financial planning hat on and I would say get a financial plan and make sure that you can afford and you're not overstretching yourself. I think that's the number one thing. And then once you have a clear idea of what's available for you and what's kind of the best financial decision for you, then you can go with your heart and then pick something that you love and you can see yourself being there for a long time, right? That's one thing. But the other thing too is if you're more, I would say, mathematical, you want to maybe look at like, okay, forecast, is this a good time versus where it's heading? I just want to pull a few forecasts for you. Again, make it, take this with a grain of salt. We know what forecasts are, but I just thought they're interesting. I want to do two things. I want to look at where prices are expected to be forecasted for 2026, 2027. And I want to look at who was right in price forecast for 2025, which I think it's interesting.
Can you share this screen or is it not? You can't share it.
It's just a few. So Korea, for example, is expecting, let's say, 2.8% increase and then 2.3 in 2026 and then 2.3% in 2027. So again, both positive. This is Korea housing forecast. Lepage, they're expecting a 1-year increase. And so yeah, so by the end of 2026. So again, those are two positive for now. Now you have Remax. They're expecting a price decrease of 3.7 in 2026. So now we have 2 to 1. The MHC housing forecast, they're expecting price increase by 2.2% in 2026 and then flat in 2027. And then, so that's 3 to 1 now. Then BMO Capital Markets, they're expecting home prices aren't going to recover those peak levels until 2029.
So peak 20.
Yes. So I'm not sure what that would work out in terms of pricing. But again, I think that would give you such a leeway, basically a 3-4 year room in terms of, if you wanted to buy something, you would still be below what we've seen in 2022, which is, again, that's their forecast. They're forecasting, again, a rise of 4.1% in 2026, again, 4.4 in 2027. So now we're at 4 to 1, or 4 to, I guess. And then the RBC are expecting a price decrease of like less than 1%, 0.7 in 2026. So we're at like 4 to 3 right now, positive versus negative. So if you look at like right now, that's their forecast. I think the takeaway from this is you by no means, I think you already know this probably, but like you by no means need to rush in anything and you have loads of time. And I don't think your decisions shouldn't be based on where prices are at now versus the end of the year. But if you're that type of person, I would definitely shop around. That's the kind of the takeaway. Now let's look at who was right in 2025.
Yeah.
So 2025 the actual drop was 2.7% nationally based on the MLS composite benchmark. And the closest was TD with minus 3.2. And the most off was actually Royal Lepage with a positive of 5%, and then Remax with positive of 5% as well. Those were like the two kind of, they said that prices would go up 5%, and then they actually end up being down, 2.7%. So I just thought it was interesting. Take forecast with a grain of salt. One of the reason why I think Sam and I has built a practice where we avoid forecasts in kind of any financial market. We do take historical, 100 years of historical data, and we do take some sort of like price expectations in terms of financial planning assumptions, but by no means we time the market and we try to predict very specific period. And it's been working wonderfully. And I think it's bringing a lot of peace of mind to clients because we don't just play that game versus a lot of I would say 80 to 90% of our competitors, maybe even more in the market. They're using their crystal ball and, I'm going to get you in before the market takes off. I'm going to get you out before the next recession. This is our, proprietary model. Like there's a lot of that stuff out there. So
I think one of our go-tos for advice is we want to control the controllables, right? And one of those, like, the market is not a controllable. Now, some people think it is, but it's not, right? Like, you cannot control what the market's going to do. What you can control is how you react to what the market does. So if we can make evidence-based decisions with your personal situation as the determining factor of when to get in and when to get out versus what we think the market's going to do that we can't control, then that leads to better decisions and more buy-in as well from the client side. And that's where the difference in trying to be a day trader versus trying to be more of a planner and coach comes into the mix, because we're going to let the markets do what they do, which is historically, even in the real estate market, they do historically go up. And so we're here talking about a moment in time where markets are down. But in the grand scheme of things, we know that stock markets go up, stock markets go down, but over time they normally go up. So what can we control? Well, we can control how you react to the times they go down, right? And the determining factor in should I buy, should I sell, should always start with where you're at from a lifestyle position and what you need that money to do for you long term, right? And if something changes in your life, like you need to buy a house, whereas previously that money was invested in the markets, that is the primary decision of when the money should exit the markets, not if there's a market correction or a market increase, right? And that's kind of how we've always viewed this. And it helps people get more educated on the subject as well. It helps them understand more about how markets work versus us just saying, don't worry about it, leave it to us. We'll get you this return. We know what to get in and get out of at the right times. Reality, like, this is a sales pitch, right?
Yeah. Let me cover what would keep the price growth in check in the real estate market. And then after that, we're going to finish with you sharing your screen on investment versus real estate dashboard, which I think is fascinating. So let me just go through the list here in terms of what will keep price growth in check, essentially based on either deterring demand or by increasing supply. So higher overall Canadian home prices may slow demand or compel many buyers, including first-home buyers, to hold off. Again, people will take more time. That will keep prices down. Economic disruptions from trade tariffs, we covered that. That could mute demand. Higher city property taxes are hitting budgets. The BC budgets came out, and I need to dive into it. It was bad. I was
Yeah.
talking with an accountant, and everything was red. And I think so. Again, they will look at ways to recoup, I think, higher taxes in some ways. So maybe that's, again, maybe they might touch on this. Many homeowners may make a move to sell, to upgrade or downsize, like AKA increase listing. So we might see even more listing hitting the market. A wave of mortgage renewals incoming the next year. So we could see more homeowners listing again. Oh, that's another one that hit Victoria pretty hard. So the short-term rental, they clamped down on this. So we saw, I think now, I'm not sure if that's already been digested by the market, but again, in terms of like one-bedroom condos and like short-term rentals turning into long-term, maybe people, they want to offload them. They don't want to hold them anymore. So again, that's maybe more listing hitting the market. Now, I'm not sure if that's already been digested, but again, that's another thing that would keep prices kind of in check. The efforts to reduce the red tape and taxes, that's an interesting one, could increase the home building pace. So as they're trying to make it easier and easier and faster to get approvals and to build, I mean, that's just going to accelerate the supply. And then significantly reduced immigration targets could ease housing demand. So, I mean, we've seen the trend reversing on immigration. And again, that's also going to keep the demand in check, which also going to keep the price in check. So those are just factors to keep in mind before trying to forecast like a sharp rebound or any sort of aggressive price increase, and try to be overly optimistic and just try to be as realistic as possible.
And I think one thing to add before we switch to going through the calculator is that there's a lot of people caught in this transition phase that are now faced with the decision of my family's growing. I need to upsize my home. I need to get out of the condo I was in, but my condo won't sell. And prices over like homes with price points or homes that would fit my need are still expensive, right? Because we did see a lot of this, I think, overweighted drop in the condo market versus detached homes, right? So even though detached homes have dropped, they haven't dropped by as much as condo prices. So it's a really tough decision to make for a lot of people right now. They might feel stuck in like the situation of trying to get out of their condo and into the next phase. And supplementing that is the decrease in average rent over the last 12 months, right? Because I believe there's been a decrease, like a downward pressure
For
on
sure.
rent. And so if they wanted to get out of their condo that they bought for way too much money, and maybe they bought it in 2020, 2021, and now they're trying to get out of that, they're looking at potentially not being able to even sell their property with enough money to pay off their mortgage, and also looking at being cash flow negative if they decide to rent it out.
Yeah.
And so it's a tough. I think those people are in the toughest positions right now. And if you're in that position, I would say this is going to be a bit of a test in that going to be a short period of time where you have to really weather kind of a storm. And we all have that in our lives a little bit, right? Whether we're just starting out and we're like drowning in student debt, or we're not making money when we're starting a business, or we go through these kind of financial times of financial adversity. I
That's one
think
of
it's
them.
really important to just take a long view of this, and what seems really stressful in the moment will likely be less stressful in 2 or 3 years. But don't make rash decisions that could really hurt your finances today just to get out of a position that may be a little bit uncomfortable. And
That's a
I
good point.
think in those cases, talk to professionals, and not professionals that are just motivated to get you to buy.
Mm.
So like, talk to a mortgage broker, yes, but don't only talk to a mortgage broker. Talk to a financial planner. Talk to someone who can help you actually price this out and give you that 10-year look into your expected financial situation in 10 years, because that'll give some perspective on whether or not you be uncomfortable in a small place for a few years, or whether or not you can actually afford to upsize even with a negative
Cash
cash
flow.
flow situation with now what you have as a rental property. So those are some things to consider. That I really do feel bad for that condo owning segment that is outgrowing that right now, because they're in the worst position of everyone in this market.
Yeah. Yeah, no, it's unfortunate. Again, it depends how you got there in the first place, right? If it was maybe a calculated move, if it was a long-term play, if it was a short-term FOMO play, then that's just sometimes the consequences that comes from making those short-term decisions, right? And that's true whether it's in the real estate market or it's in the equity market or any other financial market. If you were chasing the highs in 2007, just before 2006, for example, or you were chasing the highs in during the tech bubble of the 2000s, it's the same thing, right? You're trying to get in just because you're seeing everyone else around you getting wealthier, and then essentially when prices are normalizing, then you're faced with the consequences.
Hmm.
And that's why it's important to understand the risks and really make calculated move. It's pretty simple, but somehow being very complex.
Yeah, simple, not easy, I guess we would say,
Yeah,
right?
exactly. So, do you want
Yeah.
to share your screen and walk us through? Okay, so now we're going to cover what Sam has recently built, which is a calculator to help you make a better informed decisions whether you want to invest in a real estate property, or invest in the stock market. Actually, we forgot one thing: is the are we better off to rent or own for the last 20 years?
Yeah.
Do you want to cover that first? Yeah, yeah. Let's cover that first.
Let's
For
cover
the
that first.
Yeah, yeah, yeah.
There was give credit where credit's due here. Ben Felix has done this excellent rent versus own situation. And I think the first one he did was maybe back in 2021. and then you did an updated one in the summer of 2025, and then he just released a new one with the new data for 2026 last week. So go check that out. It's a mind-blowing video. But essentially, in most major cities, in many major cities, I shouldn't say most, as of the 2025 video, the data showed that in many major cities, you are actually better off renting and investing the difference of renting versus like the average rent versus the average home price, I believe was the comparison. So if you were to have looked at home price increases versus you just paying rent and investing the difference of what you could afford from a home versus what you could afford in rent, and you invested that difference into a diversified global stock market portfolio, you would have more wealth than you would have if you actually bought real estate, which is really pushing against a long-standing narrative that real estate is the best way to build wealth. And there's all this, this data that sometimes, so a lot of it's questionable, of like first generation millionaires and all of that stuff. They became millionaires through owning real estate and property price appreciation. And maybe that's true in a lot of cases over the last 50 years. But when you look at over the last 25 years, someone who's bought a home, the average home, versus someone who's paid the average rent and invested the difference on what the average mortgage would have cost, I believe the data shows that as of 2025, it was in a lot of cities better off being a renter. And in 2026, that's now amplified given the last year as well, with home price decreases.
I think the takeaway is that real estate is one way to build wealth, not necessarily the way to build wealth. And so is true with any investments, whether it's your own primary business, whether it's your investment portfolio, whether anything in life, there's many ways you can build wealth. That's just one of them. I think that, and then all credits due, of course, to Ben Felix and the PWL research team on that. I want to walk you through like a few of the kind of the results because they diverge. So if you look at, for example, in Montreal, where historically low rents allowed renters to invest heavily. So there, a renter who invested their rent savings would now have roughly 40% more wealth than the equivalent homeowner.
Wow.
In Vancouver, high prices and high rents, so homeowners did better. CMHC data show that Vancouver home prices and rents both grew steeply, so owners' equity soared. So estimates show a typical Vancouver homeowner accumulated about 29% more wealth than a renter who invested. Oh, that's significant. And then in Toronto, home equity outpaced rents for many years, though by 2024, the gap had closed. So the takeaway is owning generally builds forced equity over time, but isn't a guaranteed win over renting. If mortgage costs far exceed rent, renters have more to invest in stocks and bonds. Makes sense. In Canada's hottest markets, rent growth has often been as fast as price growth, so giving owners less leverage. And then for the average Canadian over 20 years, owning and renting yielded nearly the same result, which is kind of what we saw, like the 0.99 to 1 from the renters to owners ratio. Wealth ratio. And the important thing is that maximizing savings and choosing the right market. So cheap housing markets could be better for either renters or buyers depending on circumstances. So it's very fragmented, similar to how prices growth has been so fragmented over the past years. Yeah, those are the takeaways. So I think the takeaway as well is if you're renting, don't feel bad. If you're owning, then that's amazing, just as long as you're owning for the right reason. And that in either scenario, you can ultimately, the goal is to increase your happiness and live a life that you've designed and that you live in a place that you want to live in. That's really the ultimate thing. So don't feel that you need to keep up with the Jonases. You need to own to be wealthy. There's just many ways you can get wealthy. What matters is how you use all those tools for your specific situation.
Yeah, great point.
All right, cool. Last piece here with the calculator, and then we'll wrap it up.
Let's do it. So, I want to walk you through some of the inputs. Assuming a current portfolio value of $500,000 and assuming a 100% equity portfolio, assuming we can drop this off. If you're a DIYer, we'll put this to 0 for advisory fees. Real estate purchase, assuming a $700,000 purchase with a 20% down payment, closing costs of about 3%, and a mortgage interest rate of about 3.88%. The amortization period, 25 years. We could also do 30. Should we do 30 years? I think most people are taking 30-year mortgages now anyways. Let's do 30 years. Let's assume the annual gross rent is about $36,000 or $3,000 a month. That might be a little bit high. Let's assume there's a 5% vacancy rate, 5% operating expenses, and property appreciation of 2%, and that you increase rent every year by 2%. Now, let's assume that you don't put any more money into the property from like a renovation or initial capital expenditures, and you're not hiring a property manager. Let's assume that you hold this property for 30 years as well. Okay. Now, if you own this personally, right, we have to understand that there will be some taxes that will come into the equation. Right now, we're not accounting for the taxes on the personal side. If we were to look at holding real estate in a holding company, we would count for taxes in there. But what
you checked off use leverage here. Do you want to check that off or?
No, they are using leverage for real estate. Yeah.
True. Okay. I just wanted to make sure it was right. Okay. And
Yeah.
sorry, can you walk again through? So it's the $500,000. That's your current portfolio value. And then how much are you taking out of your portfolio to put on the real estate?
$161,000. That is
Perfect.
the 20% plus closing costs.
Perfect.
Okay. So what we're looking at then is the value of the remaining portfolio plus the value of the property in 30 years plus the present value of invested cash flows, right? So the rental income. Okay. So all of that formulates into something called an internal rate of return. What we're projecting on the equity side, the portfolio side, is that you earn 7.31% gross return. Okay. And that's over that entire 30-year period. What I'm going to walk you through is what comes out if your investment does 7.31%. And then what the break-even point is on your portfolio that you would need to earn in order for your portfolio to outperform the real estate side. So, what I'm going to look at first is, well, I guess we can look at the net winner first here. So the net winner in this scenario is the real estate. And there's a few reasons for that. Number one is when we calculate the internal rate of return, I'm going to scroll down to here. The real estate internal rate of return, this is pre-taxes, is 9.14% versus the portfolio rate of return versus a portfolio rate of return of 7.31%, right? So what we can see is that the real estate wins on that aspect.
Makes sense.
Yeah, so that kind of makes sense, right? So when we're just purely looking at it from a pre-tax perspective, real estate wins. If we look at cash flows on a property like this, let me just see here. The annual free cash flow. So basically when we look at the mortgage costs, where are we here? When we look at the monthly payments, so annual payments are $31,500, or monthly payments on the mortgage are $2,625. And then when we add in other costs like potential vacancy rates, operating expenses, and things like that, what that means is in year one, if we scroll back down here, your actual net free cash flow will be about $900, and that will increase over time as your rental income increases due to just the 2% increase that you're charging in rental income, right? So if you're charging your rent, increasing that 2% every year, this will start to increase over time. Now, in this scenario, one thing that we're not really accounting for is something called risk premiums. We're not accounting for this yet. And risk premiums, what they do is they look at the option of should you of basically the risk, the return demanded for the risk that you're taking. So, for example, in a 100% liquid total stock market index fund portfolio, you've got complete liquidity at any time that you can withdraw, right? So you don't have that in real estate. So in order for you to lock your money away, you should be getting some sort of excess rate of return for that. Does that make sense? Like you should be getting a premium for locking your money away. Because if I told you have option A, option B in a portfolio decision, option A and option B give you the same rate of return over a 10-year period, but option B locks your money in for the 10 years and option A doesn't, which one would you choose? Well, obviously option A, right?
For sure.
Right, because you don't want your money locked away.
This is key to understand. And we wrote that in the video as well. Like in my example, where if someone have all their money tied into a home and now they need to retire, you can't take out your door to go pay for your grocery bill. Exactly. So you need to sell, right? You need to sell the home to liquidate, to bring up your liquidity profile as an investor. And that's what we're talking about here. The liquid portfolio, you can sell overnight. The next 2 days after, it's, maybe 3 days after, it's in your bank account. And then, but you can't do that with a physical asset. And that's what Sam is referring to. So you need to factor that in order to make more of an apple to apple comparison?
So I think it's fair to label the risk premium of liquidity at 2%. Right. And we go back and forth on that. But when I've looked at the data on like what the liquidity risk premium is, typically it ranges from 2 to 3% that people demand as extra compensation for taking that risk of locking their money into a fixed asset. When we do that and we subtract the risk premium off of the internal rate of return, what we get is the risk adjusted rate of return, right? The risk adjusted internal rate of return drops to 7.14% versus the portfolio of 7.31%. So now, accounting for leverage, accounting for everything, you're looking at you're looking at a situation where after 30 years, you'd still have more potential money with the real estate, but you would not have been compensated properly for the risk that you're taking for that. So it's not, and one of the worst things you could do as an investor is take uncompensated risk, right? So what would need to happen in order for, on a risk adjusted basis, the real estate to make more sense? Well, you would need to see a higher property appreciation. So if we jump up to 3%, right? All of a sudden, your now risk adjusted internal rate of return goes to 7.9. Okay.
Which is not far fetched. I mean, I think the growth is closer to 4% historically, maybe in the last like 20 to 30 years. So, two, maybe we are undershooting it, right? So as you're increasing that rate of return, of course, with the leverage, then you're juicing up your return. And then even on an risk adjusted basis, so once you factored in that illiquidity risk that you're taking, then that's why you're getting much, much further ahead. And if you happen to be in a market where it was like maybe massively undervalued, and then you're seeing huge price growth, and maybe you're closer to, let's say, 5 or 6 or 7%, then that spread is even more enhanced, right? Which makes
Yeah.
sense.
And then
Yeah.
if we look at the break even points where your portfolio would equal the same amount of net wealth at the end, you're looking at your portfolio needing to earn 9.9%. But this is a key distinction here. The reason this is the case, you might think, well, wait a second, like my portfolio is making 9, but my property is only earning me 3% plus cash flows. Like, how does the math work here? And basically what we're utilizing here is leverage. And what you're seeing here is something called return on equity. Return on equity is essentially the dollar return for the amount of equity you have in a property. So if I have an option to purchase a $1 million asset, and that $1 million asset's going to give me a 6% return, that means that $60,000 in real dollars I'm going to be earning. But what if I only have to put up $100,000 of my own money to buy that $1 million asset? Well, now I'm getting $60,000 of returns on a $100,000 capital investment. My return on equity is crazy. It's 60%. Well, it would be 60% pre interest costs. So what we can see here is that with leverage in the mix, because you're not putting $700,000 down to buy a $700,000 property, what you're doing is you are looking at a very high return on equity in the first year. And as you pay down the principal, meaning you've put more dollars now towards the purchase price, you're now going to get lower returns over the lifetime of the property the more you pay down the principal. So if we wanted to make this an apples to apples comparison, what we should actually judge investing in property versus investing in investing in stocks, what we should do is we should illustrate a situation where you have a $700,000 property and you have a 100% down payment on a $700,000. So you've got $700,000 portfolio, and we're illustrating a $700,000 down payment on a $700,000 property. So you're buying it in cash.
Like a non-levered, but then your returns are going to be
then your returns go down, right? So if we look at this now, and let's even say property appreciation jumps up to 4% a year, right? 4% plus the cash flows you're getting on that $36,000 of rent, and people are always in a rush to pay off their homes, and that's not a bad thing. But like when we look at let's see here. Even when we take out risk adjusted returns, what we're going to see is it's very, very close. The real estate gives you 7.59% versus the portfolio 7.31%. When we add in the risk adjusted, the risk premiums, let's just account for liquidity risk, the portfolio crushes it versus a stay and do nothing and just stay invested versus buy real estate on leverage. And that's at 4% growth rates, 2% rental increases over time, right? On a 30-year holding period. What I'm not accounting for here either, guys, is the post-tax amount of rental income you'll actually be able to claim, right? And so if we were to do that, let's say you're at a 43% marginal tax rate, let's say, your real actual after-tax income on this is about 50% after you deduct for interest costs and those types of things. So if your real after-tax annual gross rent is, let's even say it's $25,000, which is low, right? Then we're looking at it being much worse to invest in real estate when we factor in taxes. Even when we take away the risk premiums, you're still looking at a total of 1% lower.
But yeah, but you also I think you're also missing the interest cost that can be deductible,
Yeah.
which is
So
not
that's why
factored
I
in as
didn't
well.
lower it by 50%, right? We can
That's
actually,
that's what it's okay. That would be
yeah,
factored in. Is that what? Okay, okay.
yeah. So basically, let's look at taxable income of 36,000. The interest cost, if we have this here, um, we don't have this on the personal side. We do have it calculated on the corporate side.
But no, I
Well, I
think
guess
that
no. In this scenario, there would be no interest
no,
deductions because it's not
that
leveraged.
yeah, that's what I okay, I see. But in the if you were using leverage, then that's also yeah, that's also like a key factor, right? And hence why I think the takeaway from what Sam just shared here is the more leverage, the more borrowing you have in your property. That's why the Smith maneuver is so popular. And just at a high level, the Smith maneuver concept is, um, I mean, it's this concept where you re-advance the principal that you're paying and then you invest it. The point is that you keep your leverage level the same throughout the entire period, so you're not paying down your principal. And that's what Sam alluded to. The more principal you're paying, the less return you're actually going to get. And then when you adjust everything on a risk adjusted basis with the illiquidity premium that you need to factor in, that's where the real estate is usually underperforming your portfolio. And then depending on but again, that will depend on a lot of factors, which is all covered in. But I think the takeaway is that it's a fascinating tool and it's just another way to help you make a more objective decision before
Mhm.
you commit, maybe tens of thousands, hundreds of thousands of dollars into an investment property. You're paying the closing cost, the realtor cost, anything, because your transaction cost in real estate is extremely high, right? If you look at a 5%, for example, versus like the investment world is, I mean, now you're looking at like pennies, but that's another thing to factor in, like getting in, getting out. Those are like big decisions. And then you at the mercy of like where prices are at. You can always sell. You might not sell at the price that you want. That's
Yeah.
the other thing too. So if you're not gonna want to get a huge haircut on an investment property you bought, that's a tool you can use to try to factor in different scenarios here to help you make a better decisions to see, does it make sense to pull money out of my portfolio to buy this? Yes or no? And so again, that's just the financial side of things. There's also the other things that you actually enjoy dealing with landlords. Let's say if you don't have a property manager, right? Some people really love that. They don't mind it. They love to go see it. I own this, I own that. If that's really important for you, I mean, this is harder to quantify, right? Versus your investment portfolio, you can't really flex. You don't show your statements to your friends, right? When you walk around, but you can tell your friends like, oh, I own like 5 condos here, right? So
Yeah.
this is just a different. It's a different game. It just
It is.
depends what matters to you and what you want to do and then how you want to go about your wealth and what makes you happy. That's any last closing thoughts here that you want to leave the listeners with?
If you want to have an analysis done, just reach out. We can do this analysis on your portfolio as well, and versus investing, and happy to do that. But yeah, I think it was a very of a substantially full episode of good information here for people to take into account of their current situation. So I'm happy we did this.
Yeah, great chat. I hope you guys found it insightful. And with that being said, we'll see you in the next episode. Enjoy the rest of your week.